I'm Lauren Hochfelder-Silverman. I oversee the Americas for Morgan Stanley's real estate equity investing business, and I have the great honor of moderating today's panel on the drivers of real estate private equity with a host of great colleagues, competitors, and friends here. Sadly, we're missing one of my all-time favorite people, Wendy Silverstein. We've lost her to laryngitis, which I think is the only thing that could allow her to say no to Mr. Blumenthal. So we'll keep it going and hopefully keep it pretty lively. So beyond how fabulous the individuals on this lineup are, I think what makes this pretty interesting, to me at least, is how different their investing strategies are, how different their formats are, their fund structures, et cetera. I think had we been standing here 20 years ago today, real estate private equity looked pretty homogenous, and so we wouldn't have had this great diversity of perspective and structure. The landscape of real estate private equity has significantly evolved over the last 20 years. 20 years ago, it was a bunch of closed-end funds, all raising their money from the same largely U.S.-denominated investors, all pretty short duration, all pretty opportunistic. In fact, I think back then they were called vulture funds until creative marketing kicked in and it was relabeled opportunistic. But today, the capital is pretty diverse, and I think the panel here really underscores that point. So guys, let's start by going through, if you can introduce yourselves, your backgrounds, and the background of the capital that you help invest in, and maybe draw the contrast with one another. Billy, I'll start with you.
Good morning. I'm Billy Rahm. I'm a partner at Centerbridge, where I lead real estate investing for the firm. I've been at Centerbridge really since day one, since before we had a name or fund or team, so I've gotten to have the great pleasure of seeing the firm grow. As a firm, we really started in end of 2005 with this idea of having one team that could invest up and down the capital structure and really present an all-weather solution in cyclical times. And that proved to be particularly powerful over the next few years as we went through a very deep cycle. I'd say over the last few years, the all-weather nature of our investing has not seemed as important, but I think it's going to become more relevant as we look forward. And from a real estate perspective, we really are kind of a microcosm of the firm. We sit inside the broader investment team, but we invest both in properties, in companies, and in loans and securities. We're really trying to find good risk-adjusted returns through cycles, both in debt and equity. We've invested a little over $8 billion of equity in real estate in those three types of investments. In the last few years, much less in credit because there haven't been great returns there. But we still think having the breadth of our strategy is particularly powerful in an asset class like real estate that is cyclical, that is a big consumer of credit, and that should present opportunities over time in each of those types of investments.
Good morning. Thank you for inviting me to be a part of your panel. My name is Kala Kutsi. I'm a Senior Managing Director and Head of our Acquisitions Group at Northwood Investors. I joined Northwood in 2009. Before that, I was with the Blackstone Group for about 9 years, first in their London office and then in New York. Northwood was founded by John Kukral, who used to be the head of Blackstone's real estate business. John actually hired me out of school in 2000 as an intern. That's sort of an interesting point. I shared...
And me.
Yes, I shared an analyst class with Billy, so it's an interesting experience, for me to be up here with Billy. At Northwood today, we have offices in... Northwood was founded in 2006. We have offices in New York, London, LA, Paris, and Denver. And really sort of to the point, we came from the opportunistic business model and that structure. And at Northwood, we tried to evolve it a little bit, or a lot, by creating a fund in 2007 that was a hybrid of open-end and closed-end architecture, an evergreen format where every year we could take in capital. Anything that we invest in, we can hold for up to 15 years, which is one of the key differentiators we have versus our peer set. And we can recycle, our capital and our gains. So to give you a thought, the fund grew when I got there about $1 billion to today is just over $7 billion. We're set up as an owner-operator. We operate in office, multifamily, hospitality, retail, and industrial. We invest on behalf of endowments, foundations, and pension plans. Those are the folks we work for every day. We're grateful for their support.
I'm John Jacobson, but everyone calls me Jake. I've been with Related for about 6 years, but before I joined Related, I probably started doing deals as an opportunity fund investor or vulture fund investor, maybe it was, back in '93 when I was at Apollo Real Estate investing alongside Related in deals. So I've had a sort of a career-long association with the firm that I've been with now for about 6 years. One of the most compelling things for me to join Related, in addition to joining with some incredibly talented professionals who I'd known my entire career, was the evolution of the real estate equity investment business from the time when I first got into it in the early 1990s until really around the time of the last financial crisis. In my mind, I really perceived that directly owning and operating real estate, whether it be in the development business, buying and turning around buildings, that was the future of the business that I wanted to be associated with. So that's why it was so exciting for me to join Related. So what does Related do? We're known as a developer. How are we an equity investor? Well, starting all the way back at the beginning of the firm, we were an investor of private equity into ground-up development transactions, and we've been doing that for over 40 years. Starting about 10 years ago, we became a private equity investor out of a commingled fund business mostly in existing properties. The clear differentiator that we have in our equity investment business is if it's ground-up development, it's related companies, it's basically the balance sheet of the company along with institutional and other limited partners alongside us. If it's an existing building that we're buying, maybe it's a distressed situation, maybe it's a rehab, maybe it's a change of use, that's something that we would buy in our equity fund. And even in the last 10 years, our investment business has evolved. So now we also deploy capital, not just in our mainline opportunistic style fund, but also out of managed accounts where we buy more, and I know we'll get to this a little bit later, but we buy more sort of core plus style assets. And we've also, in something that was mentioned in the prior panel, we've also been very active over the last 6 years investing in real estate credit via mezzanine, which is a way for us to take sort of a defensive posture, making investments that can earn an equity-like return, but have some built-in cushion against a down cycle.
Great. So the prior panel spoke a lot about competition. Competition in their space, in the debt space, frankly, and yours pretty tremendously to our benefit, to those of us investing on the equity side. But there's a lot of competition in our space as well. Lots of capital raised, including much lower cost of capital, lots of creative naming and whatnot, but the reality is that there is lower cost of capital out there, some of which taking on some similar risks to what was traditionally deemed more opportunistic territory. So I guess we'll see if this is sort of creative labeling, creative marketing, or a new phenomenon here to stay. But I guess the bottom line is, amidst all of this capital, how do you compete?
Well, for us, one of the things that's really evolved is our relationship with our partners. Because we have a very wide array of partners who invest with us. We could have high net worth individuals, money managers, foundations and endowments who have a finite pool of capital on a relative basis to invest within real estate. And that they might match up well with a commingled fund. So we're able to provide them with a couple of different options, both on the equity side and the credit side in terms of investing in a commingled fund. But we're also very attuned to the fact that some of our investors, not everything needs to be so high yield, so high risk. They have typically in the real estate allocation of an institutional investor, the equity return target is much lower than an opportunistic fund. So if we're able to create a partnership with one of our investors that meets their expected return criteria, but also plays to one of our strengths. And I'll give you an example. We are one of the largest owners and operators of multifamily throughout the United States. If you look in New York, you think of our high-rise luxury rental apartment buildings, but Steve Ross, when he started the business, it was in the affordable housing business. So we have tens of thousands, over 50,000 affordable housing units in something like 25 different states around the country. We have a big management footprint. We have the ability to underwrite, acquire, manage, create value within the multifamily space on a nationwide basis. So some of our investors who are also in our opportunistic fund, which is multi-property type, multi-location, they said, can we team up and buy cash flowing, solid multifamily around the country that plays to a particular strength of relateds. So I think having the flexibility to do something that we think is a great business model, but also satisfies particular needs from some of our investors, that's the kind of flexibility that I think that equity investors, institutional partners are looking for.
And Khaled, I think flexibility plays a big part in, I think, how you think about the world at Northwood. So.
I think the fund architecture is obviously very powerful in your ability to compete in the marketplace. I also think you have to have a very clear purpose. So for us, we've always believed to achieve the higher rates of return, we need to solve an issue. Years ago, it was a liquidity issue, and just having capital and being able to deploy it and speak for it was the differentiator. I think even today, if you look at it, you still need to solve an issue for someone to achieve a higher rate of return. And as an example, so early on this year, we focused, and towards the end of last year, we focused on motivated sellers. We've always been trying to get in front of who's a seller and why are they a seller. And the ideal situation is they're a seller because they need liquidity, not because they've maximized the value of an asset and they're just looking for the lowest cost takeout. And so towards the end of last year, what we noticed was the capital controls that were coming down in China were limiting the ability of the Chinese to expand, but also more, they were in need of liquidity. We went and cataloged all the, all the different investments that these groups had made, instances where they had developments that needed to be finished, instances where they, would require capital, and in assets that we would want to own and markets that we would want to own. We cataloged all that, and we focused on, and we underwrote in what instances would they want that capital and can they transact. And what we learned as we were spending more time out there and spending time here was, they couldn't really transact inside of their basis. So while they were the high bid, a lot of their situations needed to be resolved, but they couldn't transact inside of their basis. And we focused on situations where, assets were acquired at a point where they had a lower basis, where we can get in front of them, do our work, and then put a proposal together for them. And we were successful in doing that through the acquisition of a building in San Francisco, through the acquisition of a building in New York. And we continue with that theme that you always have to solve something for someone to justify the rates of return that we're seeking for our fund investors.
So you always have to solve something, but maybe, Billy, as we transition to you, do you feel like you need to take more risk today to get the same returns? Are you taking different types of risks?
I don't think you necessarily need to take more risk. And look, I think in any cyclical asset class, this is not specific to real estate, there are really only three things that you can toggle. You can toggle risk, you can toggle return, or you can toggle pace. So during the financial crisis, we had 12-month periods where we invested several $1 billion of equity in real estate because you could achieve our absolute levels of return without taking on a lot of risk, and you could do it in real size. I think in the last 12 months, really in the last probably 36 months, we've had to be much choosier, so we've toggled pace. I think for other investment firms who maybe have a double sort of standard between sort of their assets as well as their returns, it's much harder to toggle pace. And so what they've done is, I think probably smartly for their business, tried to attract lower returns so they can toggle return without having to toggle risk, which is clearly the most dangerous one to toggle. That's really where we've tried to focus. So I think if you looked at the returns of what we've done in the last few years, they'll probably be as good or better than our 10-year returns. And I think part of that is we've been very choosy, and I think the things that we've been investing in have worked out pretty well. I do think, to your earlier question about sort of core plus and other asset classes, I mean, at the end of the day, there's a certain return for a level of risk. And and what Jake's talking about, I think there's good rationale for people to accept lower returns for some of the types of affordable housing or multifamily that Related's been involved in for decades because, one, they know it really well, but two, those are, assets in markets where there's a real long-term supply-demand imbalance for housing, and they're able to have persistent cash flows. I think you've seen core plus, or whatever label you want to put on it, start moving into much more operationally intensive asset classes where fundamentally they're just overpaying for assets. They're accepting a lower return, but not accepting a lower return because the operational nature of the assets have changed, but just because they've decided that the way to compete and win and maintain pace is to accept a lower return. And so that's, I think, where people may not necessarily have the kinds of capital loss that they experienced during the financial crisis. We can talk about where people might have capital loss, but will probably end up having returns that are lower than they expected because the nature of the assets and the riskiness of it is different than what they might have attributed to that type of capital.
Well, if I can just tag on to that for a second. I think one of the issues we're seeing, one of the challenges in the Core Plus space is it's also how it's implemented. So you have teams, and you're seeing the strategy show up in shops where they have the same team doing value-add opportunistic investing, but now they're doing Core Plus. And I think it's all too human for somebody who spent their entire career taking opportunistic or value-add risk to maybe underwrite a certain risk profile, but to a lower return through a Core Plus vehicle, which is maybe what we're starting to see in the market.
You know, just my own, talking about risk, right, the R word. One of the great ironies of this business, and one of the things that maybe we'll talk later on about, like what keeps us up at night, but is the fact that, strangely enough, you know, in the private equity real estate investment business, the lowest risks have tended to be in the times of the greatest turmoil, because you have the greatest ability to sort of pick and choose deals, you have pricing power, there's a lack of liquidity, and those in retrospect have ended up being, you know, the best times to invest, and when in fact, you know, it didn't look like it didn't feel like it, but that was the lowest risk time. A time like right now feels like the time that's the highest risk, because you have pricing that's, maybe pricing has plateaued, but it's been the same for several years, and it's way higher than it was in the last downturn. You've got interest rates rising, you have all these risk factors across the horizon. So we have been very, very choosy, and that may be another reason why, on a risk-reward basis, we've shifted some of our emphasis over the last 3-4 years into credit, and into more sort of buying stable cash flowing assets where we can make an impact, but we're not expecting to make an 18, 19, 20% IRR.
Yeah. So let's talk about let's talk about that. Let's talk about where we are today. I hate the obligatory cycle clock question, but there are lots of conflicting views out there. I think last night the Federal Reserve Chairman said, quote, "We're in a good place and I believe our economy can grow and grow faster." And you look at many in our industry who point to limited supply and other fundamental strength points and say, things are good, we're going to keep going. And then you look at others who point to impending doom, who talk about trade issues and interest rates and all sorts of other things. As you guys look out at the world, and let's try to get a little bit specific and talk about liquidity, let's talk about outlook on cap rates, rental growth, total returns. Where are we, and what's your outlook in the next few years? Billy, I'll start with you.
Sure. I mean, I think, you know, on the fundamental side, you sort of just look at supply and demand. On the demand, you have still pretty good GDP growth. You have consumer confidence near all-time highs. You have unemployment very low. So you have a lot of factors that are very positive. And supply, you know, has pockets, certainly, of oversupply. But, you know, on national averages, which is always a little bit dangerous because we invest in the specific, so we can speak about the general. That's not really where we invest. It's more manageable. I do think there are some early signs of some concerns. You know, one of the byproducts probably of strong demand and economic growth is rising costs. Mm-hmm. And you see that, you know, one of the benefits of the way that we're organized at Centerbridge is that we sit inside of a broader investment team, and I sit in the firm's investment committee for private equity. We own close to 40 companies, and we see rising wages, we see rising input prices, and ultimately, you know, that will put pressure on margins and cash flows. It will also probably contribute to the other thing which everyone sort of talks about in real estate, which is interest rates. Mm-hmm. It's going to be very hard for the Fed to keep rates low if you have the early signs of inflation, and I think we see, you know, that in a number of respects. The only real way that companies throughout America are going to be able to overcome rising costs is by increasing price. And so that's going to contribute to what was really started through quantitative tightening, but rising rates. And so, you know, all of that summed together is going to contribute to rising total cost of cash flow for real estate, right? Operating cash flows are going to have rising costs and rates are going to rise. And so for us, the real question is, where do you think you can drive growth in the top line to overcome that, and so that you're not as reliant on your cash flow during the hold coming from low rates and low costs, mm-hmm. or on the residual from cap rates staying low. So we have definitely been focused much more in areas where we can either drive value through our operational expertise, or where we think in the very specific, there are real secular tailwinds, because I think anyone who's underwriting real estate today has to assume that cost to operate and cost to finance are probably only going to accelerate from here, and that's going to have a meaningful impact on the return profile of assets.
I think that's right.
Okay, so I'd echo a lot of that sentiment. I think Jake said something that I picked up on, which I agree with. Our investing pace, we used to put $1 billion of equity to work every year, and then over the last 3 years, we've pretty much slowed down to around half or a third of that amount. And really what we've been seeing is, obviously, a lot more capital's entered our space, which has created more competition. Whatever it is, core plus, it could be in any strategy, it could be debt-driven, but we've seen more capital. The other thing that has led to us being much more cautious is, the assumptions you now have to believe and the method by which you achieve your returns are incrementally increasing the risk. And by that, what I mean is, first, the method, most of the transactions are now more heavy lift, and you're getting more of your return through the residual versus cash flow. So you don't really get to buy down your basis, and you figure out whether it's a good or bad deal 5 years from now. The other thing is the assumptions. Rents pretty much everywhere are 20 to 30% above the prior peaks. Capital values everywhere are 20 to 30% above the prior peaks. I'm not saying, and we're not projecting that tomorrow things are going to decline, but we have to anticipate that they may decline and that the drop could be more material. The other thing that we're noticing and that we've picked up on, which maybe 3-4 years ago wasn't there, is this risk of correlation. So, I mentioned that we bought a building out in San Francisco. We spent more time really studying this, and is the correlated risk to a tech downturn, which we don't get the sense, other people maybe are picking up on it, but here's sort of what I mean by that. If you look at the returns in the S&P for the last 3 years, 1/3 of those returns have come from like 5, technology stocks. And what that's doing is it's pushing, potentially allocations for CIOs in allocating capital to real estate. So you see that on the capital market side, but also those same companies plus groups like, WeWork, which, Wendy's not up here, so I can say that, have been driving the bulk, a substantial portion of the absorption in each of our markets. They're speaking for 1/3 to half of all the absorption. So to the extent there was a deceleration in their fundamentals, to the extent they're taking space they don't necessarily need, you could have a scenario where space gets put back on the market very, very fast, which is frankly how I started my career, 18 years ago with Cisco and a bunch of those groups putting a ton of sublease space back on the market. You could be getting that back right at the moment where the denominator effect creates this incentive for the CIOs to say, I want to reduce my exposure to real estate, which puts pressure on, it creates these motivated sellers that we go after. At the same time, you have this backdrop of rising rates or an elevated rate environment. So we're not projecting, that scenario, but it could be there, and we need to have the dry powder to take advantage of those situations when they come up.
Well, so just on that note, I think we all invest predominantly in the private space, but you're touching upon the public markets and obviously a lot of volatility as of late. At a minimum, history will tell us, I think, that at times where the market is down meaningfully and or pretty volatile, that has an impact on the underlying economy for a variety of reasons. How big of a deal is this volatility as you think about your investing today? Maybe Jake or Billy?
Can I just pick up, because Jake mentioned this earlier, about when you have the best opportunity. If you looked over the last 20 years and said when VIX is below, VIX is sort of the volatility index, which is not a real measure of risk, but is a measure of volatility. When VIX is below 10, so people feel like the world is good and everyone's pretty complacent, the 2-year forward S&P is down -2%. When VIX is above 40, the 2-year S&P return is plus 20%. So, when people are scared, it just fundamentally means prices change. And at the end of the day, all we're trying to find is good price. I mean, it is good price relative to the amount of lift we have, good price relative to the amount of cash flows we have, but good price. And I do think that there will probably be a leading indicator of a change in private markets that will come first in the public markets. We do have the flexibility to invest and have considerably in public markets. It just hasn't been a great place to deploy capital in the last few years because the relative returns haven't been great. I think that opportunity may change, and it will be a precursor likely for some correction, maybe not as dramatic, in the private markets as well.
I mean, I share that view that real estate is no different than other industries where the public markets can tell you a lot about where the market is likely to go. I've always, there are points, if you look back in different cycles, where the REITs basically told you now's the time to sort of lighten up on core real estate and get a little bit of cash ready to do some sort of higher risk stuff. I always wish in those moments that I had some affiliation with a big pension fund that had a bunch of core fund investments, because REITs price a lot more quickly than most open-ended core funds. So if you could somehow play the arbitrage between the REITs are down, now I can get in the queue to sell my, I'm not saying anybody should get in a queue to sell an open-ended core fund. They're great. We don't have one, but they're great. But somehow timing, we can't time the market. Mostly what I know is that I don't know. I mean, rising costs, I completely agree with. We see it in the development business in spades, especially because of the markets in which we do most of our business. We're in the big markets in the development business: New York, Boston, Chicago, LA, San Francisco, Washington, DC. Costs are up everywhere, not just land costs, but labor costs, materials costs. Costs are up, interest rates are rising. I mean, despite the best efforts of the panel that was before us, spreads can't go to zero, right? You can't have spreads, compensate for rising short-term and long-term interest rates forever, which I believe has been, it's been a sort of a mellowing effect on what could have been a cap rate increase over the last couple of years. So with rising interest rates, rising costs, a lot of weird stuff going on in the world. Brexit, which, hey, there's a deal done, but of course there's not really a deal done. A trade war with places like China that, we see it in some of the things that we do is more serious than maybe people are giving attention to. All of those things, I can't put to any of those things as causing some big correction, but I do know in my heart that there will be a correction. I just don't know where it's going to come from or where it's going to come. So all we can do in the interim is price risk effectively, focus on deals where we really can add value operationally, rather than sort of play some cap rate arbitrage, because we're not smart enough to do that.
So you referenced Brexit. I have to say, coming out of last week's midterm elections, I think in a world where we're all braced for big surprises post-Brexit, post the U.S. 2016 election, maybe the biggest surprise coming out of last week was that there wasn't a surprise. How do you think about policy implications? Does this change anything? Is it, par for the course? Where are we?
This is not an original idea, but I subscribe to it, which is you got to believe that the long talked about and long delayed infrastructure spending that the country desperately needs, they'll finally come up with some sort of bipartisan solution because Congress is really great at spending money. It's one of the things they're best at. And so the idea that you could have an infrastructure spending, it's good for our business. Infrastructure is good for the real estate business. So that, I think, is a positive, and the only potential downside to that is, does it sort of create fiscal stimulus that adds to inflation and causes, because Congress and the Fed don't necessarily work off of the same playbook. But I think that is probably a positive for our business that comes out of the now divided Washington.
That's great. Anyone else?
Yeah, I mean, I would just say I don't know whether or not we'll get infrastructure or not. I do think that it's a good example of, we talk a lot about rates. It's not just in your financing costs and your cap rates, right? It implicates a lot of other things, including, the cost to do this infrastructure bill is meaningfully more expensive than it would have been 2, 4, 6 years ago. And, we see it also in regular businesses. So, I think you have to look at the valuations, not just of real estate companies when we talk about the public markets, but also of the other companies who are the users of our real estate. And if you looked at basically every recovery in the last 40 or 50 years, only 25% of the recovery in price came from multiple expansion. 75% came from either sales growth or margin expansion. This recovery, 55% came from multiple expansion. And if you stripped out the technology companies we were talking about who've had massive growth, 75% came from multiple expansion. So we haven't seen as much growth. And so when you think about that, I just am coming back a little bit to rates. It does have an implication for users of our real estate. If their prices come down, that will make their balance sheet feel more expensive, and their ability to grow, I think, will change. Just as with the U.S., I think the cost of financing this infrastructure becomes more expensive. That's never, stopped Congress from taking actions they think are politically expedient. But, if you're thinking about it from an analytical standpoint, it should be a factor.
Yeah, I'd say you look at the U.S., you look at Germany, you look at the U.K., I think you have pretty much political gridlock in every one of those areas. And in some ways, short, sharp bursts of some certainty, in the sense nothing material is going to come out of it one way or the other. I agree that there could be some bipartisan decision to do some infrastructure spending. There could be maybe a little bit of bipartisan decision-making coming together to regulate some of these tech companies, which may not be entirely, which could be negative. But in general, we're seeing this in the UK, we're seeing this in Germany, we're seeing this in the US. I don't project anything material. Frankly, in some ways, you can make the argument nothing's going to happen until 2020. And that might be good for some planning purposes for the next couple of years.
So you're comparing the US to Europe, or to certain countries in Europe. This morning's Wall Street Journal, I think, had a headline: "Global economy shows strain as the US steams forward," or steams ahead, something like that. You all invest to varying degrees on a global basis. How do you think of the U.S. in a global context? Do you have regional biases at this point in terms of outperformance, underperformance? What do you think?
Here's what I've noticed. 2008, people were making the argument that the U.S. had decoupled from, and a slowdown in the U.S. wasn't going to affect the world. Europe and Asia would steam ahead. And you had material reductions in economic output in Japan, in China, in Germany, in Europe. And this time around, you had Brexit in 2016, July 2016, and I really thought that the UK was going to fall off a cliff, and it continues to grow. Europe continues to grow, China continues to grow. I continue to believe, actually, the US is the engine of growth. And as long as the US is firing on all cylinders, its consumption base, which is 75% of a $20 trillion economy, continues to lift and pull most of these areas, whether through services, across Europe, or maybe through consumption of durables from Asia. So as long as the U.S. continues to charge ahead, I believe that's the reason why the U.K. has defied gravity despite Brexit.
So I think that in the long run, ignoring China and not paying very careful attention to China, even though it sort of takes a year to figure out exactly what happened sometimes, we do so at our peril, because it's going to be the largest economy in the world. I don't know when that is, and it's policies in China are going to have long-term impacts on things all around the world. One of the things, it's been sort of widely talked about, sort of the retrenchment of some of the Chinese firms, many of them not under the control of the Chinese state. And there was a perception that they'd gone a little bit too far in terms of their international expansion, especially into things like U.S. real estate. But, and I can only really speak anecdotally about this, but the perception that I have is now, even the state-owned companies, sort of China as an entity, for whatever reason, maybe it has to do with politics, maybe it's the trade disputes. China is shifting away from investing money in the U.S., at least in U.S. real estate. It's going to invest somewhere. It's going to invest in places like Europe. It's going to invest in the U.K. And so that has an implication over the next 1, 3, 5 years for us. And so I think watching that very carefully is pretty important for us. They have a leader in place and a government that is sort of unified, all sort of moving very much in lockstep. And if they want to make plans for the next 5 or 10 years, they can do that. And so I think for us to watch what those plans are and try to discern that, I think is important for all of us.
So, sensitive to time and wanting to get the most out of this panel in the shortest amount of time as possible, I'm going to switch gears and go to a lightning round. So I'm going to go straight down the line, and I guess each of you can give me a 1 to 5 word answer on a bunch of topics. So first question, biggest macro concern today. We've referenced recession, trade war, interest rates. Is it that? Is it something else? Let's start with you, Billy.
China and rates. I think those are 3 words.
Tech downturn.
rates.
Okay. And I guess this is coupling with the last one, but what about getting more specific geopolitical risks? I think I know the two ends, so Khaled, I'm just going to make you answer it.
Italy.
Interesting. What's your highest conviction, most interesting investment strategy today?
Multifamily.
Okay.
Okay.
Yeah, what they call in the UK build to rent, purpose building rental of quality, institutionally owned, managed in the UK in strong markets. That was more than 5 words, way more than 5 words, sorry.
I'm not policing well enough. And you said multifamily?
I agree with multifamily. I think the UK could be a fascinating multifamily market. I think where it will be interesting is there's a massive pool of multifamily in the US, and it operates, for whatever reason, with the trillions of dollars that we have over here, it operates at 65% margins. But for whatever reason, the UK, they think they're going to run 80% margins. It'll be interesting to see, can they really pull it off or not?
So, Billy, are we going to be 3 for 3 with residential?
No, I would say, I mean, I do think there are housing opportunities globally in certain markets, but technology, despite Khaled's comments about tech downturn, I know I'm expanding beyond 3 to 5 words, technology-driven real estate, I think, is a profoundly secular opportunity. And whether it's David Lehman's comment on data centers, whether it's wireless towers or ground leases on wireless towers, whether it's tech's ability to change the use of real estate in certain areas, clearly that's true in warehouses because of the drive of e-commerce. I think wherever stock prices go, and they've obviously gone up for tech companies because cash flows have gone up, I think there's going to be continued demand driven by the impact of technology.
And what about the opposite, guys? Are there sectors or market strategies you're staying away from today, Jake?
I'm trying to count the words.
Yeah.
So I agree with the comment from the prior panel that retail is probably oversold, but it's still scary.
Khaled?
I think logistics is probably an area that we're staying away from. The idea behind it makes perfect sense, but at some point it gets bid to a level where, frankly, the risk is asymmetric to the downside.
I'll say office because of the capital intensity of it and the potential cyclicality, and therefore in a rising rate environment, you really have an asset class that has big use of capital, and that's scary. The one thing I would say, just to build on what both Jake and Khaled said, if you go back to not that long ago, let's say May, when Prologis bought DCT, they paid arguably a 3.9 cap, and high quality real estate, great sort of secular thesis around how you have demand growing for warehouses, but fundamentally an asset class that's not that hard to build. And at the same moment, because of everyone's terror around retail, you had grocery anchored shopping center companies. These are not owning C malls; they're owning community shopping centers with your top performing Kroger or Publix or other high quality grocer that traded north of a 9 cap. One of them traded almost a 9.3, so you inverted the decimals. And what we found interesting about that is if you ran out 10 years, 15 years, 20 years, the difference in cash flow growth that you need to achieve for the industrial to get to a similar cap rate, you had to have, on a 10-year basis, 1,000 basis points of differential growth. And the only thing I know is that the power of compounding is generally underappreciated. And doing that on a compound annual basis for 10 years is incredibly difficult, particularly in an asset class that you can build. Because all it takes is year 5 or 6 to grow 3% or 4%, which is still not horrible. And then you need 12, 13, 14% for the last few years. And I think that's very unlikely to be achieved. And so that's where I think price matters. Even in strong asset classes and even in asset classes that are facing more headwinds, we're always very focused on price.
Okay, well, so this clearly is not lightning round. Billy, I know we can do it faster. So you mentioned, only because Billy is the person that is best at math of anyone I know, so I know he can. Anyway, you referenced technology. What technological change do you think will have the biggest impact on your investment strategy? Billy?
Mobile. I won't say any more words.
AI.
Those are good, but I'll say autonomous vehicles.
Good. Okay, last one. Biggest surprise next year. Biggest potential surprise.
Bipartisan governance.
Amen.
Yeah, I'd say a smooth plan in Europe on Brexit.
Both of those would be very surprising to me.
So I'm going to switch gears in our last few minutes. A lot of NYU students in the audience here. Can each of you provide a piece of advice to them, something you wish you knew when you started out and/or wish you had focused on more clearly?
So I think I innately knew this when I was starting out, but I may not have paid as much attention to it. But any job you take, whether it's an internship or like your dream job, fundamentally comes down to the people. You need to be working with people that you respect, that you can learn from, that you can grow with. There's no more important thing. People talk about millennials as some monolithic thing. It's not. Millennials are not a monolithic group, right? No group is monolithic. But the idea that millennials will sort of hop from job to job to job to job, I'm telling you, if you find great people to work with and you can work with them for a long, long time, stick with those people, because that's how you can really grow and build a career.
Yeah, I'd agree with that. A great piece of advice that was given to me by somebody who wasn't even in the real estate business. They were in the corporate private equity side of our old firm. They told me that we're all about the same level of smart in the real world. What differentiates us is effort. So you have to work very, very hard to achieve the results you want. The other piece of advice I would give you, in the 18 years I've been doing this, is people like to do business with people they like. So try to make friends.
I'd say bet on people and follow your passion. I think people who really work harder because they like it. And that's an important thing too.
It's true. And, it's interesting, Jake, referencing jumping from job to job. I think that's certainly a trend. And when I look at the three of you, and I'll group myself in there, there's not a lot of job hopping. I mean, there's...
You're the only one that's still at your first place, right?
I think you have two, three, whatever. But the point is a lot of duration, and I think... it's just interesting, the world and how people approach jobs is shifting. I think there are probably benefits to both. But anyway, I think we have 2 minutes left, so I'm going to open it up to questions if we can. If there are any.
You'll have to save that question till the session with Steve Ross, because he's the one who did it. I certainly didn't do it, and I just didn't want to get all the way through this panel without saying Hudson Yards.
And I tried to design it to not talk Yoruba.
It's 2 words. It was the qualifiers for lightning round.
Any other questions from the audience?
Lauren.
Jump in?
Is that Rob?
Yeah, it's Rob.
Always the best question in the room.
This is a little advertising so people stay to the end of the day, because the best is at the end of the day. It's the Opportunity Zone panel. It's the hottest topic. You guys are at the forefront of chasing opportunity. Opportunity zones. No one really knows what it means, but everyone's saying it. And I can't believe the comment that was made about the connection between crummy retail, C malls, B malls, no alternative use. And the reality is some of these are probably in opportunity zones. So you guys are investing a lot of equity capital. No one mentioned that. No one said in the lightning room opportunity zones as an opportunity. Did none of you see that? Is this just a big 1031 sham where people can just roll tax risk into the next deal? Or are you guys seriously looking at opportunity zones as an investment deal?
I think we're all studying it. I definitely wouldn't call it a 1031 sham. I think, frankly, every young person should be running around chasing hedge fund tycoons, trying to convince them to take their capital gains and let them invest in these opportunity zones. We're all, I think, researching them, but it's not yet clear to me exactly how. And I'm a huge proponent. I love the idea of government incentivizing us to invest. You look at sort of Ireland, we noticed that them cutting transfer taxes down from 6 to 2% and saying if you hold an investment for 7 years, you don't pay capital gains, was a big driver in why capital showed up in Ireland. So I'm a big believer and a proponent of that concept. I just don't know yet exactly how you're going to take these gains and invest them in these areas. Who are the sellers? I don't know what it's going to do to the pricing of assets in those areas. You have to invest 101% of your basis to qualify, so I don't know what that's going to do in terms of labor cost components. So I think it's a great idea, but we don't yet know exactly how it works, and we're all probably studying it, I'd imagine.
I mean, we're very focused on it, as you can imagine, because we do match capital, in many instances, high net worth capital with highly appreciated assets. We're in the business of matching capital with really interesting real estate opportunities. And so, the one thing that we're staying very focused on, though, is the tax incentives of an opportunity fund deal can't outweigh if a deal just doesn't pencil. So the deals have to work first. And we spend a lot of time, we're very, very choosy about deals, but we've identified a pipeline of deals that we think is attractive, and we would do otherwise. If we would do the deal otherwise, and it sits in an opportunity zone fund, that just drives us to where the capital is going to come from, more than the capital driving us to go and find some deal that may not pencil out.
Good morning. Good morning. Am I on? Okay. Good morning. Sam Stathis from Stathis Enterprises. There's people at this table that are better qualified to give the legal definition of forward-looking statements that past performances will not predict future results. But we also have to look at that if we keep doing the same, what's that, one definition of insanity, doing the same thing over and over and expecting a different result. Now, close to 40 years in the real estate and construction industry, we've seen at least 4 cycles up and down, and right now we're experiencing very good times. Many people at the previous panel, I'm sure on this panel, agreed that it can only last so long unless we do something a little different. I'm very bullish and excited about the fact of technology, and I'm going to make a prediction, and I would like to have some of the panel question perhaps. The 3 I heard about technology was mobile technology, AI, and autonomous vehicles. We're in a room filled of the top developers in the world, some of the biggest financial institutions in the world, and there is a prop tech movement that started years ago, and we are at the very beginning of that. And this is not the .com. This is technology tied into brick and mortar. I predict, and I guarantee, that we are going to ride this out for many, many years to come. And I'd like to hear from our panel about how prop tech and new innovations, for example, Silverstein Group invested, I believe, $100 million into silver tech. JLL, about $100 million. There are a dozen companies, I'm sorry if I didn't mention you, in this room that are investing millions of dollars into real estate and construction technologies. We should look at that because developers are all of a sudden interested in making jobs more efficient. We were always behind schedule and over budget for the last 50 years, and I think that's where we need to focus. And I'd like to hear from the panel. Thank you.
I agree, it's super important. I can't tell you which to pick the winners and the losers, but it's extremely important, and we're in the early innings. I agree.
Yes.
Yeah, I agree with that completely. I think technological advancements, automation, you heard somebody say it on the panel before, provides a deflationary effect. I think the idea of increasing productivity helps grow our economy and add jobs. But we also have to make sure that people that are displaced can be reskilled and can be effectively redeployed into the workforce.
Great. Well, I want to thank all of you so very much, and thank you.